Hello, welcome back. So Snapchat is actually up today, about 8%, after announcing an insane amount of layoffs. If you take a look at their stock news here, you will see that why Snap stock jumped on Wednesday, that market may not be as bad as thought, and the company is actually rallying more than 10% at some point after company confirms layoffs, launches restructuring. Let's take a little bit of a look at what they are saying here. You will see that they are actually cutting their full-time employee headcount by 20%. And that is obviously huge. That's a massive cut in terms of employees. And sometimes the Wall Street can actually see that as a positive, sometimes as a negative. When you are cutting down on so many employees here, you could actually have a positive effect in the sense that you're actually cutting down on operating expenses. However, you may also cut down on performance. You may cut down on how much you produce. And so, as long as you are cutting down on positions that are not really needed, you may be doing well. And this is looking like what the market thinks pretty much, that this could be more of a positive sign than a negative one, frankly. Now, the company also said that they have bought back 3% of its outstanding shares in the last earnings report, which I'm not really sure it's great for the company because they are not really profitable yet. I mean, they are kind of profitable, then they are not profitable. I mean, it's they're kind of on a balance there. They are not like losing money all the time, but they are not also making money consistently. So the cost-cutting measures could make the company free cash flow positive at current revenue levels, is what the article is claiming here, that could potentially be the case. And of course, you can kind of see that the stock price has been absolutely been going down like forever here. And again, investors could potentially think that there is a restructuring plan here that is aimed to give its business more focus and make it more profitable here. Now, you, of course, will see whether that is going to be the case. Now, management said these moves will help Snap save 50 million annualized in fixed content costs, which are categorized as cost of revenue here. And further, it anticipates 450 million in annualized adjusted operating expenses here. Interesting to see. So that should lead to positive free cash flow, is what they are saying here. They did warn investors that visibility for future revenue growth remains limited given uncertainty in the micro environment, which we know about pretty much. Now, in this news, in hearing this news, you can kind of see that another stock that has been completely annihilated, Meta here, we can kind of see it, has also been soaring after this this report pretty much. And you will see that it's also up 4.6%. At some point, it was actually up like 7% today. Then the market's turned a little bit. If you take a little bit of a look at the dashboard, you will see that the Nasdaq is just green right now. It used to be a little bit more earlier in the day. With companies like Bed Bath & Beyond is actually down 20% today. Let's go back a little bit, since we are here and talking about Snapchat and Meta. I want to go back to Snapchat because it is a company that is interesting in the sense that it has lost a lot of its value, and we have talked about it. It's down 90% almost. Seeing at the 5-year chart, it's basically the story of a boulder rolling down the hill pretty much, and you will see that they are not really making money here. And in terms of the free cash flow, it just becomes slightly positive because of some adjustments, but they have bought back 3% of their outstanding shares. So they have actually issued 40% though. And so just buying a little bit more doesn't make... it's good for investors generally speaking. However, it's only good if the company is profitable and they can actually spare this money in order to be buying extra shares. Otherwise, you don't want them to be spending money buying back shares, because you want them to spend this money to actually make their operations better, make more money pretty much. And by cutting down on employees, I don't know if this is going to turn out being a good thing, but generally speaking, it shows that there is a slowdown, a pretty important slowdown in the at least their business or the advertising business pretty much. And you will see that the company is also not solvent as well. Like, the free cash flow is not enough to cover the total liabilities. It would take like 20 years to do that, which means that the company has quite some debt, I should say, or quite some total liabilities is the more correct way of saying it. And you will see here that their net income margins, the return on equity, they are in the negative because the company is not really making money. And again, a quick look at the income statement, which again we have looked at before, does show a company that they have been increasing their revenue, so they have been growing, which is nice to see. However, their net income has been in negative territory. And if you take a look at the cash flow statement, it is only the adjustments that make it positive, and you will see here that it's sitting at 290 million. That's because of a lot of stock-based compensation here, which gets added back to the operating cash flow because it's a non-cash expense. However, it was extracted from the net income. So in this situation, you are pretty much looking at a company that is losing money overall every year. Now, losing a little bit less every year, which is a good thing to see, of course, from a company which you at least could potentially be waiting on a turn, pretty much. Now, you will see here that the free cash flow again has been in a positive territory lately, and sitting at about 180 million over here at the last year, again due to the adjustments. But overall, the company has been in a pretty much in a position where it's not really been making money yet. Now let's take a little bit of a look at some other interesting things here in regards to the company. Kind of interesting to see that a lot of people are actually super bullish here. Some other people are actually super bearish here. Most actual reports here are bearish, as you'll see. Most of them are in the red. So a lot of analysts are thinking about moves that are going to be on the downside here for Snapshot, which is interesting to see, and may deserve a little bit of caution here. And as always, you can use our tool here to take an exact look on the article itself and see exactly what is being said here and what is being discussed in terms of the analyst targets here, like 17 to 15, for instance, in this specific one, as you'll see. And yeah, this 17, it's a buy rating and lowered. They did lower the buy rating here from 17 to 15, but at the time that this was written, it was 10. So this is still an upside for the stock over here. The price was posted, price when posted was $10 over here. So interesting to see, yeah, this kind of ideas from analysts here. Now that doesn't imply that this would happen, of course, but it's nice to know what they are thinking. And you could potentially dig a little bit deeper and see exactly why they're downgrading or upgrading the stock here by examining the actual articles. Okay, so the last thing, since we're here again, I kind of want to take a little bit of a look at our stock evaluation tool and see what we can come up with this one. Again, it's a company that has been growing tremendously. We will go with a lot of growth, but not that much growth as it has enjoyed in the previous years, because it has been out of the ordinary, of course. In this current micro environment, we are expecting them to grow less. But let's try 10, 20, and 30, since we are not profitable yet. And remember, the fact that we are not profitable is making it much more difficult to discover, to actually get a value out of this one. Because it's when something is not making money, what is actually worth to us? Well, if it's going to make some money in the future, it does have some worth, but if it's never going to be making money, it's not worth anything. So we just need to be making some assumptions here. And the company's margins, have, as you'll see, have been in negative territory. However, we do need to assume marginal profitability, otherwise it makes no sense to be buying this one, like 1, 3, and 5%. Free cash flow margin, I'm gonna be, let's just go 100% here for all of these, which basically means, when I'm going 100%, basically means 1%, because it's for this one is 1%, for this one is 3%, and for this one would be 5%, because it's a percentage of the net income margin over here. And when we're going 100%, we're saying that the free cash flow is going to be 5% of the revenue, pretty much. The reason why the tool is doing that is because it tries to correlate the free cash flow to the net income, which is the proper way of doing things, because you want your free cash flow to be derived from actual profitability, and this is why the tool is operating like this. And remember, you can gain access to this tool by becoming a patron. By the way, you can find links in the description box below the video. Okay, so let's hit the calculate button, and what are we getting out of this one? And you will notice that even at this kind of aggressive, I would say, revenue growth numbers here, especially the high one is rather aggressive, 30%, and it's still we're sitting at a max price of $5.5, and a net income margin of 5%, which the company is nowhere near achieving yet, at least. So even at this value, we're looking at a $5 high, and we're sitting at 11 almost. So even though this has dropped tremendously, an insane amount, this cannot be bought right now. It's still a company that is very risky and very expensive to buy for what it is. So I would avoid this for now and just wait. Maybe it can go down much more potentially, and even start making even more money, and then it becomes a much more interesting target to value investors. But thank you for watching the video. Please remember to like and subscribe. And if you haven't watched that, you may want to take a little bit of a look at that video that I made earlier. And I'm talking about Meta in this one. So take a look at this one because it kind of correlates with Snapchat. They're not the same companies, nowhere near, but it may be an interesting watch after watching this one. And thank you again. I'll see you soon. Bye bye.